But let's turn now to the markets and your money, because with all this stuff going on, guess what? Stocks, they're still higher. The bond market slowly starting to shift, all as the Fed feud unfolds. Joe Davis is chief global economist at Vanguard. He is head of Vanguard's investment strategy group. Joe, don't worry, I'm not going to ask you to dive into the politics of this, but I will ask you, does a fight over any Fed governor like this, without going into the details, because we don't, to be frank, we don't know much, but a fight at the Fed or about or over the Fed, does that influence how you or what you recommend to your clients in any way?
Well, it certainly could, but it's not right now. I mean, clearly Federal Reserve independence is important, primarily because it just makes monetary policy just more effective. And that has implications for the interest rates we see and for the financial markets that we participate in. Again, we ultimately tend to focus on economic fundamentals. And that's clearly what I think, despite the headlines that we are seeing at the moment, more likely than not will drive the markets over the next several months.
Yeah, if Cook, we don't know what's going to happen. Cook is removed. Somebody else comes in that is more dovish, that they are more likely to agree with faster or deeper cuts to interest rates. Do you adjust your models and say, well, I guess we'll be 0.25% or 25 basis points lower faster than we thought? Is that kind of how the thinking would go?
It could go. I mean, this is not the first time that we've had, debates, even among portfolio managers, or is the Federal Reserve writ large, dovish, hawkish. These are conversations we have all the time, just in sort of normal environments. I think the also thing is what the bond market is saying, because what the shape of the yield curve may be, where inflation expectations are, currency markets, they will have a very large bearing. And in fact, are some of the indicators that we will ingest and think about for our outlook.
Yeah, we look at the U.S., we look around the world, and the U.S. has had a pretty good run. Yep. But the rest of the world, Joe, as you know, has had a better run than the United States. Do you see a trend, the international over the U.S. trend continuing, or will we pivot back to U.S. outperformance?
Well, we believe there is a timestamp to U.S. exceptionalism, and that's not necessarily a pessimistic statement. Now, again, we have said this for the record for several years, and so clearly the U.S. markets have outperformed. The S&P 500 has dominated any equity market, but we have to be forward-looking. And so I think whether you are bullish on AI, for an example, or you're bearish on AI, tends to leave you down to the same sort of let's diversify outside the U.S., because it's unlikely we will continue to see this outperformance. We just can't time when that sort of transition will occur.
Yeah, and it's what's amazing is not only has gold outperformed the U.S. equity market, I think, over 25 years, but many bonds have as well, because you have the 2000 collapse, you've got the 2008 to 2010 collapse, you had that very brief tariff collapse. Where is there opportunity on the bond side? We love talking stocks, but guess what? There's a lot of money to be made in the bond market as well, Joe.
We couldn't agree more, and it's been one of our theses of our entire investment management team. And, our outlook this year was on if you're going to take some active risk, the fixed income market is probably more compelling today than it has been in 15 or 20 years. We have a higher interest rate that's above the rate of inflation. One of my colleagues says bonds are back, and I think it's a great phrase. You're earning a higher coupon, and whether you're a little bit skittish on the equity market or just trying to drive real returns, it's solely not an equity story, which was the case 5 or 6 years ago. We've been rewarded on that. But from a return perspective, as well as a diversification perspective, fixed income is very compelling. I mean, that's both corporates as well as munis.
Yeah, and quickly on the Treasury side, the 230 spread, that yield curve, it's the highest in 3 years. It's really moved off the bottom. Do we need to lock in return now? If one of our viewers, your clients, listeners right now says, you know what, I'm nervous about where rates are going to go. If you want to get, 4 or whatever % on Treasury, should we lock in, buy a longer dated note now?
Well, I think you'd want to think about it depends, all right. But I think you want to have some intermediate exposure as a starting point. If you go short duration, where people have wanted to go, they've missed that sort of upper sloping yield curve that you're talking about. If you're trying to lock things in, I would just caution: what's the exit strategy when the Federal Reserve, let's say, they ease 2 or 3 times? Are you getting back in? Just think that through. It's the re-entry point that's usually the challenging part of being a little bit more tactical in this environment.